Welcome to MARKETSnap Educational Series, an easy and convenient way of learning basic concepts about investing and financial markets. All explained in an easy and accessible form. The series starts with the basics of investing part. In this second video, we will learn how to choose an investment strategy that is right for each individual goals and risk tolerance. So, how to choose your investment strategy? Choosing an investment strategy can be a complex process, but it's a crucial step in achieving your financial goals. Before explaining all the different types of strategies, there are a few factors you'll need to consider when choosing your strategy. I will list 10 of these factors, and to make things easier, I'll divide them into two main categories: personal factors and general factors. Then, once you're aware of them, I'll go through all the strategies that you can pick from. So, this video will be divided into three main parts. The first section will help you better understand and define what type of investor you are, therefore what type of strategy can better suit you. The second will cover general aspects to consider when choosing any investment strategy, regardless of the type of investor you are. In the last part of the video, I will list and explain all the different strategies. By the end of this video, you'll have a better understanding of how to choose an investment strategy that's right for you. So, let's get started. What type of investor are you? Personal factors. 1. Your risk tolerance. How much risk are you comfortable taking with your investment money? If you're risk averse, you'll want to choose a strategy that is less volatile. For example, you might invest in bonds or CDs, which are considered to be less risky than stocks. If you're more comfortable with risk, you may be able to choose a strategy that has the potential for higher returns, such as investing in stocks or real estate. 2. Your investment goals. What are you hoping to achieve with your investments? Are you saving for retirement? Are you saving for a down payment on a house? Your investment goals will help you determine the right time frame for your investments. For example, if you're saving for retirement, you'll want to choose a strategy that is designed for long-term growth. While, if you're saving for a down payment on a house, you'll want to choose a strategy that is more liquid, so you can access your money when you need it. 3. Your time horizon. How long do you have until you need to access your investment money? If you need to access your money in the short term, you'll want to choose a strategy that is more liquid and less risky. For example, you might invest in money market funds or CDs, which can be easily converted to cash, without the risk of capital losses. If you have a longer time horizon, you may be able to choose a strategy that is less liquid, or more risky, but has the potential for higher returns, such as investing in stocks or real estate. Any major, temporary, capital losses in the value of your investment are more likely, but not guaranteed, to be offset and recouped over a longer period of time. Do you already know what type of investor you are? General factors. Whatever type of investment you'll choose, here are some additional tips. 4. Costs. Be aware of costs. There are several costs associated with investing, such as management fees for mutual funds and ETFs, or brokerage fees. Costs get even more important when you invest in real estate, where they can be sometimes more difficult to estimate compared with other types of investments. For example, legal and administrative fees, maintenance expenditures, sneaky corporate fees, and property taxes. It's important to estimate and consider all these costs when choosing an investment strategy. 5. Taxes. Taxes can also have a significant impact on your investment returns. They can be very different from country to country. Usually, investing-related taxes can include capital gains taxes, dividend taxes, withholding taxes, property taxes, transactional taxes. It's important to understand the tax implications of different investment strategies before you invest. 6. Do your research. It's essential that you do your research before you invest, even if you get professional advice from a financial advisor, and understand the risks involved in each type of investment. If you invest in stocks, remember that you're buying shares of a real company, not just a ticker symbol. Research thoroughly any company before investing in it. If you want to be a successful stock picker investor, This means going through financial statements, earnings estimates, checking various valuation ratios, calculating intrinsic values, listening to conference calls, etc. Don't worry, if all this sounds overwhelming, there will be dedicated videos where I'll walk you through all methods on how to value a stock, in the next part of the educational series, called How to Value Stocks. But since this is still the basics of investing part, let's keep it simple. Not necessarily everyone wants to be a stock picker. It requires a lot of time, dedication, and effort. But this doesn't mean that you shouldn't do your research even before putting your money in ETFs, or mutual funds. Obviously, same thing goes for real estate and other types of investment. Research is paramount. You should also read the prospectus for any investment you're considering. 7. Start small. If you are new to investing, it is a good idea to start small. This will allow you to learn the ropes without risking too much money. 8. The longer the better. Invest for the long term. Investing comes with ups and downs. However, if you invest for the long term, you are more likely to see positive returns, as well as the powerful effect of compounding. This will be the subject of the next video, the power of compounding. 9. Diversify. Don't put all your eggs in one basket. By diversifying, you can reduce your risk. How, and how much to diversify? I'll go in depth about this topic as well, in one of the following videos of the series. 10. Be in control. Being in control of your investment can sound easy, but it can actually be the most difficult part of investing, as it has a lot to do with the psychology behind it. Again, I'll go more in detail in another video of the series, titled, The Psychology of Investing. Being in control means to fully understand what you are investing in, whether it's a company or a different asset. If you don't understand the business model of a company, why would you invest in it? Being in control means also rebalancing and reviewing regularly. As your investment goals change, you will need to rebalance your portfolio. This means selling some of your investments and buying others. Not just your goals will change over time, but the market as well. Especially in the stock market, things can change sometimes fairly quickly. There can be very different types of markets, different macroeconomic conditions, different events, and therefore different sentiments. If you have a long-term perspective, you don't need to obsessively keep monitoring your portfolio for every small market fluctuation. As the legendary investor Warren Buffett once said, buying a stock can be similar to buying a farm. In both cases, you are buying into a business. However, if you have bought the farm, it's because you thought the farm had potential. You won't have a daily quote telling you how much your farm is worth, and frankly, you won't care if there was any daily fluctuation. Similar to what would happen if you own a house. The recommendation here is to apply the same psychology to owning stocks. But being aware of these fluctuations will often give you the opportunity to take advantage of new buying or selling opportunities. So, at the end of the day, be in control. This also implies having the right strategy. Therefore, once you've considered these factors, you can start to narrow down your options and choose an investment strategy that is right for you. So, finally, here are some examples of different investments for each factor, followed by some common investment strategies. For risk tolerance. For low risk, bonds, CDs, and money market funds. For medium risk, index funds and mutual funds. For high risk, stocks and real estate. For investment goals. For retirement, index funds, target date funds, and annuities. For down payment, CDs, high-yield savings accounts, and money market funds. For time horizon. For short-term, money market funds, and CDs. For medium-term, index funds, and mutual funds. For long-term, stocks, and real estate. The strategies. More in specific, if you invest in stocks, here are some popular investment strategies. Buy and hold. This is a long-term investment strategy that involves buying and holding investments for a period of years or even decades. This strategy is generally considered to be less risky than short-term trading. Value investing. This is an investment strategy that involves buying undervalued investments. Value investors believe that the market is inefficient and that undervalued stocks will eventually rise in value. Growth investing. This is an investment strategy that involves buying stocks of companies that are expected to grow rapidly. Growth investors believe that these stocks will provide higher returns than the market as a whole. Dividend investing. Dividend investing is a strategy that consists of creating a portfolio primarily composed of dividend-paying stocks. The goal is to create a substantial stream of passive income that focuses on long-established companies with an excellent track record of financial health and consistent dividend payout, quarter after quarter. With dividend investing, an investor can potentially profit of the dividend, as well as share price appreciation. There's then a variation, more day trading oriented, of dividend investing, that is dividend capture strategy. Dividend capture. The dividend capture strategy consists in the timed purchase and subsequent sale of dividend-paying stocks. The dividend is captured specifically by buying a stock just prior to the ex-dividend date, in order to receive the dividend, then the stock is sold immediately after. However, because markets tend to be somewhat efficient, stocks usually decline in value immediately following ex-dividend. So, the viability of this strategy has come into question. Again, don't worry, if you don't know what an ex-dividend date is, I'll go through every single relevant strategy in detail, one by one, in the next part of the educational series. So, stay tuned, and by the way, before we keep rolling with the next strategy, don't forget to subscribe to the channel, so you won't miss new episodes. Dollar cost averaging. Last, but not least, dollar cost averaging is an investment strategy that aims to minimize the impact of volatility when investing. It's a common strategy used by index funds ETFs investors. It involves investing the same amount of money in a target security, at regular intervals, over a certain period of time, regardless of price. Investors can use dollar cost averaging also to may lower their average cost per share of individual stocks. Therefore, to reduce the impact of volatility on their portfolios, eliminating the effort required to attempt to time the market. Be mindful that these examples provided are not exhaustive and do not represent a fixed or definitive rule. Instead, they are just a few examples among many possibilities. In conclusion, it's important to remember that there is no one-size-fits-all approach to investing, so you may need to experiment with different strategies or combinations until you find one that works for you. Thank you for watching. Please leave a like if you appreciate the educational series. See you on the next video. We'll learn about the power of compounding. And remember, if you subscribe, you won't miss your tomorrow's convenient MARKETSnap overview.